You can have the best credit in the world, but if your debt into ratio does not indicate you are not a risk to the lender, they're not going to give you the money. So that's why you wanted to take your debt into ratio seriously if you're considering having a capital like real estate assets. To another video. If you have watched one of our video called Financial Vital Sign previously, please watch this video before you watch this video, because this video might not make sense to you. If you also watch another video called Understand This Before You Start Family, please watch that video also before you watch this video, because these videos are in sequence. Okay, so with that being said, the video of today is how to create or build assets or capital using your income and savings. And how does that even make sense? I wanted to use it to make sense to you today. So please pay attention today, because I'm going to go in steps by steps. Okay, understanding this is going to help you qualify, becoming eligible for loan. And lenders, which are the banks, are the one giving loans. So in order to get loans to fund your assets, building your asset, because you need other people's money, and that's bank's money. Bank will fund you to go buy assets with their money. So in order to do that, I'm about to show you how to get yourself qualified and eligible with a concept called debt to income ratio. Okay, so debt into ratio income ratio is based on your income and savings. They are aligned to your expenses. If you recall, I was talking about previous videos called ICE, the financial vital signs. I was talking about income, capital, expenses, and savings. Now I wanted to make more sense to you the power of income and savings to create assets, all right, to create capital. Now, how to do that is through effective management between your income, savings, and your debt, which is your expenses. So step one is you wanted to get a list of your expenses on a monthly basis. To put this video in practical approach, get a piece of paper, write down your monthly expenses. Your monthly, you can do monthly, you can do annual, as you please. But in this video demonstration is monthly expenses. In this video exercise, I have rent, I have food and water, and I have clothes. Those are my basic needs. So my rent in this video is $100 a month. My food and water expenses also $100 a month. While my clothing is also $100 a month. Total $300 monthly debt, which is my expenses. Okay, now let's go to step two, which is my income. For the income, I have two types of income. I have wages from my time and energy I'm selling to another employer, handing me $500 a month, and my dividend also handing me $500 for my stocks that I bought. Okay, so that total is $1,000. So what I wanted to do with this $1,000, I wanted to create more asset other than my dividend. But let's assume that you don't even have anything. Let's say in your case, all you have is one income, which is your wage or salary, whatever it is, right? And that will be total whatever you calculate in your piece of paper. Now goes to step three. Now you're going to put that together, $300 over, which is divided by $1,000. That will give you 0.30, which is 0.30. Multiply that by 100%, will give you 30%. That means you have 30% of your debt into ratio. So in layman terms, what it means is out of your 1,000 income, if you break that into three portions, which is going to be about 333.33, you only use one portion of that, which is 1/3 ratio out of your total income. So lenders, you are a really good borrower to give funds to. They see you as a good person to give money to. That's how lenders see you. Lender doesn't know or don't care about your name, your background, and all that. In America, thank God for that. In America, in the United States today, lenders see you by debt into ratio. So you wanted to keep your expenses extremely low if you are planning to have assets like housing, buy a house, or buy capital through lender to fund you. So for real estate in the United States of America, if you have 30% or 36% below, you are actually looking best in front of lenders. Any lenders you go to with this kind of 30 to 36%, you are the best person to lend money to according to them. There's other factor which we're not going to mention in this video, like your credit score and so on. But this is the major qualifying eligibility for lender to give you loan. You can have the best credit in the world, but if your debt into ratio does not indicate you are not a risk to the lender, they're not going to give you the money. So that's why you want wanted to take your debt into ratio seriously if you're considering having a capital like real estate assets. Okay. Other piece here is if your debt into ratio is up to 40 to 50%, you are okay. So every lender has different guidelines. You wanted to check with your lender. However, I'm just speaking in general in the United States of America. Most lenders prefer your debt into ratios to be extremely low or be in between 36 to 40%. Then you're actually good, a borrower to lender based on calculating your eligibility of risk. And then calculating your risk with maybe 40, 50, you're okay. Above 50, you are not good borrower according to the lender. If you like, you might have 850 credit score. At that point, bank doesn't care. You might make all the money in the world, but if your debt aligning high to this ratio, you are not looking good. So I want you to pay attention to this video. All right, so thanks for watching. Please share this video, comment, like, subscribe. Let me know what you think. You need me to elaborate more further about this video, debt into ratio, how to create asset using your income and savings. Please let me know through your comment. Thanks for watching.